impacts inflation and leads to financial risks. And that's within our mandate. And to show you a little, like, on inflation, on prices, we saw the droughts in Spain, higher prices of olive oil because less production of olives. We saw impacts already from floods. Well, at the moment, people are getting their feet wet in Central Europe. That leads to damages there, leads to financial losses of banks that are invested or have mortgages in houses that granted mortgages to houses that are in those areas. So it really comes to the core of what central banks do and prudential supervisors act on to keep banks safe and keep prices stable. But for me, when was the Climate Change Center created? The landmark moment was really in 2021, July 2021. That's when the European Central Bank concluded its monetary policy strategy review, looking, okay, what should we take into account when implementing our monetary policy? Climate change was front and center of that conclusion. And at July 2021, the European Central Bank, together with all the 19 central banks that are in jurisdictions that have the euro, agreed on an action plan with 9 concrete actions. This is what we're going to do to address it. So that meant on data with statistical indicators, it was on implementing in our forecasting, taking into account climate risk in the portfolios we hold. So a lot of different moments. I joined just a few weeks before this was announced, and my job was making sure, well, the ambition there is to make sure that we take into account climate change in all the core tasks we do where relevant. Secondly, to make sure that we deliver upon our commitments. So we published this climate action plan, well, with clear deadlines, what we're going to deliver in the coming years. So that's something I had to monitor also. Are we on track? Do we face difficulties to deliver upon it? Because we are accountable to deliver upon what we committed to. And the third ambition is also, because we collect a lot of knowledge, also share it with others. So we inform policymakers to make better decisions. There's also a wider public. This is what we see, how climate change impacts our economies, our macroeconomics, our financial risk for banks, and this is what needs to happen. And maybe the role is quite unique for big banks, but if I look in Europe, so I work very closely with all the national central banks within Europe. And all of them have, in some way, some central unit that deals with climate change. Either it's within one department or it's somewhere, but there's one central place. And that comes because it touches on so many aspects of what central banks and banking supervisors do. So to have some place where it's a home, where things come together and we push it forward, that's why it's impact, how does it impact monetary policy, collected insights from all around the globe. We did things on supervision and all other aspects there. So I see that's a trend, and it's really still growing. There is a growing awareness on climate change and the effect it has on our core task.
How well supported is the role as the bank in this by elected leaders across Europe? Because in the United States, climate and the Federal Reserve's very ginger engagement on that front is something of a third rail. The Fed comes under constant criticism if it is seen, crossing a line into what elected leaders ought to be pursuing. Is that something you hear much in your role in Europe, or is the role that was formed here much more embraced, do you think?
Well, if I talk about Europe, we have a very clear target, a Green Deal, with a lot of policy and a lot of investments and support going and regulation targeting to transform the European economy to a greener economy. So there's, of course, this is impacting our work, because if that happens, that means that the economy needs to transform. That could lead to risks, or how do we make sure that we get everyone on board? So, of course, there is an impact on that we take into account, but at the moment, I don't think we expected that. So we were still hoping that we would transform in time to shield us from more extreme weather events. But sadly enough, we're already facing quite extreme weather events, and the damages from these extreme weather events are really increasing at a rapid pace. So regardless of your political sentiment or things, how you can approach it, I think this physical risk aspect, it's something you have to deal with regardless where you are in the globe. And
understanding that is central to your role, right?
Yeah.
I know one of your colleagues, a policymaker, Frank Elmsford, who's on the executive board of the ECB, in a speech about 6 months ago in Brazil, talked about there being substantial progress having been made in the macroeconomic modeling around climate risk. What does he mean by that? And how are those models actually being implemented at the policy-making level?
So what we do on the macroeconomic side and the modeling, one important piece of work is climate scenarios, because a lot of the macroeconomic models that we're currently working on are based on historical data. Well, guess what? The most changes will occur in the future, and how do you prepare for that? So together with a lot of other central banks under this auspices of this network, we've created, together with climate scientists, climate scenarios. Okay, this is how the world would look like if we transition at the pace agreed in Paris. So that means a lot of transition measures, a cleaner economy, going away from fossil fuels. What is it if we act too late? That means that we probably have to push it quicker. Okay. So that means that it will be more disruptive. And what is it that if we don't do anything? So we live in a very hot climate. So we have these scenarios. On these scenarios, we do our stress testing also from the economy. So we did an economy-wide climate stress test. Looked at.
What did that tell you?
Well, the main takeaway there is that we better invest in the transition now and front-load those investment, because if we leave climate change unabated, the cost will be much more expensive. So we push the bill towards the future.
And is this primarily public investment? And if it's not, how are you creating incentives for the private sector to join this effort?
The investment gaps are huge. Right, so there is an uptake in climate investments, but it's mostly still been going to what is green and stimulating a more greener economy. But we still have a lot of our economy running on fossils and hard to abate sectors. Like if you think about high energy companies that produce steel, how are they going to transform? But they produce products that are essential for our economy to run. So how do we make sure that it is being funded? Last year, the European Commission indicated that we need, up till 2030, more than 650 billion a year extra to fund. This cannot only be carried by public funding, so you need also the private funding to be crowded in. And a key aspect there is also clear policy pathways, like how are you going to transition? So if you're a car manufacturer and you have to make this investment in a new plant, new factory, and you're still aiming to have produce combustion engine cars, if there's a clear phase out of combustion engine cars at a certain deadline, it's easier to attract money to build a plant that's building electric cars than it's combustion engine cars. So a clear policy pathway, like when do you expect the economy to change in certain aspects. I think this is really helpful to crowd in investments from private companies. But also, I think that's more in the U.S. with the Inflation Reduction Act. A lot of money went into, so that's more the fiscal stimulus side.
Well, that's true, but it's the difficulty, of course, is in changing consumer behavior. And if an electric car is so expensive that it is unaffordable except for a government subsidy to buy it, what's a phenomenon like that going to do about progress toward that private investment match?
Yeah, you still need a lot of private money to be crowded in, and like how much do you need to de-risk enough to have private companies, banks and insurance and private investors to crowd in that funding. And this clear policy pathways, like where are you going, help to crowd in investments, private investments. But also, I think you need to know better where you're invested in. And that's where data and disclosures come into the story as well. So companies need to better explain, okay, this is the carbon emission I have currently, but over the years, this is what I'm going to reduce. This is my path to transition. And if every company around the globe does such a kind of transition plan, it's meaningful, right? It does something. It's reliable, so you know it's true what they say, and it's comparable. It's also easier for private investors, private finance, to find the sources where you can invest in more sustainable future.
Staying with companies for a minute, I mean, there's quite a lot of work underway too in corporate disclosure around climate risk, right? Tell me a little bit about the role there, what progress you see being made, what can we expect to hear more regularly from companies about not only what they say their own carbon footprints are, but progress toward reducing them, if at all, and how accountable can the bank how can they hold companies accountable?
Yeah, so that's a perfect question, Dan, because I see a lot of developments going on sustainability disclosures in general. So the IFRS Foundation created an International Sustainability Standard Board, and they came out with standards. And these standards have to be adopted by governments and implemented in their national jurisdiction. So that's the global standard that we see. In Europe, if I talked about my own place where I'm come from, we have a corporate sustainability reporting directive. So next year we will see the largest companies in Europe disclose more sustainability information. And
what are some of those details that I should look for, or my colleagues who cover European companies should look for?
So it's really broad. So it covers how you set up your governance, but it's also it's on climate. So what is your carbon exposure? So that's on the transition side, but also the physical risk side. How are you exposed to physical risk? And this is, I think, your point also. It's not like only the company, but also the environment it operates in. If you're a company and your value chain, your supply side depends on something that is being under threat, and let me give you one example here. Going to a car manufacturer again with an example, a lot of them use these chips, like these semiconductors. A big supplier of semiconductors is based in Taiwan.
Right.
Taiwan faced droughts in 2021, 2023. To produce these semiconductors, you need a lot of cooling water. This drought affected the production of these chips, these semiconductors, so there was less supply, so it hampered the productions of cars manufactured around the world.
It hastened the first wave of inflation that we saw coming out of 2020 into 2021, which then grew into a much wider phenomenon.
Yeah, and in some places in the world, it was affected because of droughts. So if you're a company and you have to know not only like the plant where you sit and you produce, but also like the supply side towards your company, is that being affected by climate change? Is there more severe weather events? Can that impact? Can droughts or wildfires like hamper your whole production lines? So this is something I expect more insight will come with the sustainability disclosures in place. So that's also on the climate side. The European reporting requirements also require to publish information on pollution, on biodiversity, and also social aspects. So a lot of that kind of information will become more available.
Okay. On the sticking a little bit with supervision, there's a significant deadline for the end of the year for banks in Europe to meet fully your expectations around incorporating climate risks in their strategy, government, and risk management. And again, it was Mr. Elderson who, in his, this was 6 months ago now, but said, there had been progress made, but at that time, not one bank was meeting all of those expectations. This is a year-end deadline. We're 3 months out. What should we expect? Should we see universal compliance? Is it going to be 50-50, 25-75? What should we see? Because this is a major deadline coming up.
Yeah. So let me take you one step back, and this comes back to in 2020 we issued supervisory expectations.
Yes.
So we explained to banks, okay, this is what we expect you to do to manage climate-related and environmental risks. On indeed strategy, governance, risk management, but also on disclosures. We looked indeed in 2022, we looked, okay, are banks compliant? No, the glass is not even half full. But if you look at all the practices together that banks did, and we published that, we saw that it's possible to comply because we saw good practices on each of every element of the expectations we've put out. So in 2022, we said, okay, here you are now, not ready yet. No bank in Europe we assess as climate proof to deal with the risks. By the end of 2024, you have to meet the deadlines. But we also set interim deadlines. So in 23, we already required all banks to do a materiality assessment. And this year, earlier this year, it was on the strategy and also on the governance. Mm-hmm. Because first you have to know where the risks sit. And nearly all banks found that climate-related risk and environmental risk are material.
Okay.
And that was not at the start, right? So you saw an improvement, so you also have to know the unknowns.
So they're identifying this as material, so this is material in their asset portfolios, the loans they're making, they're seeing risk there, or what other?
Yeah, so those are, I think, good examples. For example, on mortgage portfolios, on also assets you hold in very polluting sectors. Mm-hmm. How big is your concentration risk? What is your credit risk coming from? So it's not a standalone risk, right? You see it how it's affecting your credit risk as a bank, your market risk. So all those elements are taken into account. So
the deadline comes.
The deadline comes.
The deadline comes. What are we going to see in come January 1?
So we already earlier said if banks don't comply, we don't shy away from enforcement measures.
Yeah. So what's enforcement look like?
So some banks did not meet this interim deadline of materiality assessment or the other, and we already issued periodic penalty payments.
Okay.
And that's not like it's a fine right here and right now, but it means that if you don't comply within the certain deadline on the expectations we have set, you need to pay a fine. Mm-hmm. And that fine is dependent on your profits, or it's on the size of your bank. So that could be pretty material. So this is what we are planning. So this is, I think, Dan, this shows just how serious we take it. Mm-hmm.
And in those instances where you're encountering shortcomings in these interim measures, where is there commonality where banks seem to be failing the most frequently, or is it, it's across the board? Because it's a complicated matrix that you're asking them to abide by here, right?
Yeah, but I think it all starts and it depends, because there are banks from all walks of life and sizes. So it really depends also where you stand. But having the basic in order, do your materiality assessment, set your governance in place, do your risk assessment. But for example, we found that only in 2022, only 20% of the banks, we found that they are taking climate change risks into account when granting loans.
So in the initial underwriting process?
Yeah,
right?
Yeah. And that's only 20%. And it doesn't mean that climate change is always an issue, but you have to be aware what the risks could be and act accordingly if you see it could be a risk. Mm-hmm. And we surveyed also.
And was there something interesting geographically about that? Was that happening in areas where, you're lending on the southern coast of Europe? Shouldn't you be aware of flood risk? And that was not the case?
I was expecting this, but this was not the case. So it was.
It was across the board.
Yeah, yeah. And banks from large banks, smaller banks, retail, corporate, across the board. So okay. That's fascinating, right? And here maybe one point of what I see, it also comes down to personal leadership. Right? Often the tone of the top is really setting the tone of, okay, this is important, we have to take it seriously, and we embed it in the full organization. This is helping my job. Mm-hmm. What you said, I'm reporting directly to the president. Mm-hmm. This helps also within banks to make it that seriously. To take it that seriously, that climate change is something you have to take into account. You have to have the knowledge, you have to get the data, the information on it. What is it? And then you have to act accordingly.
Mm-hmm. So are you working then at all, directly with the ECB's, formal supervisory staff to facilitate these conversations with bank leaders? Are you sitting down with bank leaders yourself 2, 3 times, 17 times a year to drive this point home?
So my role is ECB-wide, so from monetary policy, how we produce our banknotes in the most sustainable way, what's happening on the banking supervisory side. So it's really across the board. The dialogues with industry, with banks, are taking place by the people who are supervising them.
Right.
And of course, I have, in general, some meetings a few times a year with head of sustainability or head of climate risk from banks to learn a bit more in general. Okay, how do you see the developments going, or prepare them? But these difficult conversations, okay, this is what we see, this is not, you're not doing enough, this is taking place on the supervisory arm. And we're a small unit, right? I'm a unit of around 10 people. And that means that I have all the expertise in-house, but the real work needs to happen where in the core of the business, at the monetary policy side, at the economics and the financial stability in the supervisory side.
We talked fairly substantially about the investment gap. There's also a phenomenon you've referred to as the insurance gap here, which is also very significant. United States, for instance, we've seen some regions where property insurance is either is getting incredibly expensive, or providers are no longer writing policies in disaster-prone areas. It might be coastal Carolina or Florida, California wildfire regions. Is this something that you're viewing there? Is this because I think one slide you had in a presentation talked about there being only something like a 25% coverage rate for real major disasters, and is that narrowing? Are you seeing things like what we're seeing in the United States and Europe with these insurance gaps, and how significant is that?
Yeah, this is an important point. With the increase of extreme weather, more wildfires, more floods, more droughts, there's also a reason to shield more from it. Insurance can be an important buffer. So we look together with the European Insurance Supervisory Authority how well is Europe insured against these catastrophes? And what you mentioned, indeed, this was our finding. Only 25% of natural catastrophes in Europe are insured currently.
That's a phenomenally low number.
And in some countries, it's even 4%. So it really differs still within countries in Europe. So that's low. And that's worrisome for several reasons. First, people who suffer the damage, right? They don't get reimbursed from their losses, so they have to carry the loss themselves. Secondly, it's for banks. If you're invested in you have a mortgage on a house there, how are you? You lose the value of that house. So that's the second thing. Thirdly, it's also for governments, because if the disaster is huge, everybody still thinks that the government will step in to get it up and running. So we looked also into options like how can we make sure that this insurance still covers? What are options to have insurance, reinsurance, cat bonds maybe, and what in the end? How can you have kind of a ladder approach there, that the first buffer is still being insured? Because you see indeed damages of hail are sometimes excluded from insurance, or sometimes flood areas or wildfire areas. Mm-hmm. And insurance plays such an important role to get the economy up and running quicker, right? Because you're shielded from these instant damages.
Now, what role can the ECB really play here? I mean, you're not an insurance regulator, but this is a valuable piece of insight. What is the bank's role in ensuring that somehow this moves from 25 to 30%, or some trajectory improves? And that insurance, as you note, really needs to be provided by the private sector. And if the actuarial models say, don't insure the Iberian Peninsula, what do you do then?
Like every central bank in the world, we're not a policymaker, we're a policy taker.
Right.
But we do our analysis and we found, okay, this is the risk we see, and we share our knowledge and we bring it to policymakers and raise the alarm bells. Okay, this needs to be fixed, because we're seeing the macroeconomic impact it could cause. We see that the banks, the financial risk it would cause going forward.
This is New York Climate Week. Tell me a little bit about the agenda that you're pursuing while you're here, what you're learning, and what you see might be some encouraging signs or disheartening ones as you make your way around New York this week.
Yeah, so I think it's always standing on two legs. There's hope and there is fear. So yesterday I attended a great presentation of Professor Rockström, and he identified the planetary boundaries. And that means, at some point we cross it and we lose it. And maybe this comes to the point, are we truly valuing the point that is in the existential things in our economy, in our lives? Because if you look into a lot of, yesterday I looked, what are the highest value companies in the world at the moment? Well, what do you think is on the top?
Well, they're all the AI crowd, right?
That's all the tech.
Mm-hmm.
What if they go bankrupt tomorrow?
I mean,
pretty disruptive, right?
Pretty unlikely.
Yes, but imagine, they go bankrupt tomorrow or in the coming days. We would still have food, clean air, fresh water. We would still exist. Mm-hmm. But at the moment, we're really hampering those the foundations of our economy. It's really degrading at a fast pace. So we have to preserve it where all our economy is based on. So how do we better value what we still need in our foundations, and are better connected with the lives around us and the world around us? And this is also, we're looking a lot to climate. We have to look into nature at large, because it's bringing a lot to our economies, which we're currently not valuing. And it's also leading to a lot of risk because we're so dependent. We looked into 4.2 million companies in Europe, and we looked how are they dependent on services that the planet has providing us for free, like fresh water, fertile plans, we found that over 70% of these 4.2 million companies in Europe are highly dependent on at least one ecosystem service. So, and at the same time, we know that it's heavily degrading at a very fast pace. So to better value that and take that into account with our lives, because we have to make sure that we continue going forward. This is really key. So this is something I learned, and I really think we're late. We're terribly late to address it, but we should not give up. So that comes in like the hope. There are the international energy agencies predicted that the investment in clean energy are as twice as much as in fossils at the moment. In the country where I'm from, the Netherlands, 1 in every 3 households has solar panels at their roofs. We see that investments are increasing. So now is the time to think, okay, not only be distracted by the natural catastrophes and see how we can deal with them, also making sure that we future-proof our economy, prepare ourselves going forward, and make ourselves more resilient on the climate damages that we are already confronted with.
A little while before the interview, you were mentioning you're also having some conversations with ratings agencies while you're here. You know, a bond credit rating is nothing more than a letter score that is valuing the risk of that bond or that issuer. What's your sense of the way, again, because central banks are involved in mitigating bond market risks directly, and so ratings really matter. Do you think that the ratings agencies are taking this into account in assigning the ratings that they're putting on both individual issues and on the issuers themselves?
A lot has improved going forward, like taking this climate risk into account into the rating, but I think it counts for every one of us that it's just so hard to measure and to predict. So I think this is something we really have to improve going forward, because other elements that this whole transmission channels of how does this drought in Taiwan eventually ends up at the balance sheet of a bank, or that's something we just need to know more about. So not only the risks that are sitting on the collateral on the place, but really this whole, and there are possible tipping points that could make it if we cross a certain level of global warming, we will see an increase in sea level rise. So we can still, how do we calculate, how do we formulate that, and how do we act on it? So I do see that credit rating agencies have picked up, but need to do more, need to know more about also what kind of methods are they using to assess it. So I think the more transparency coming from them could be useful. But we all have to know more. We're just at the start, and at the moment, we have to rush up because we're too late.
I want to return again to just the ECB, your unit's role in it, and what we most pay attention to, at least my crowd pays attention to with the ECB, is obviously what it does with interest rates and inflation. And it has a number of tools to address that. It has the policy rate, but we also know that the ECB, like the Federal Reserve, has they've become frequent asset buyers at different types, at different times for different purposes. There is an aspiration to have, for the ECB to have, a greener approach to quantitative easing. Right now we're in the shedding process. It's not really, pertinent right now, but it's likely that quantitative easing is going to have to be applied again down the road. How are these principles going to affect the approach on a very important monetary policy tool? Are the bonds of an oil company going to be totally no-go if there is another round of corporate bond buying? Things like that. Mm-hmm.
So our anchor is, and our primary focus is price stability.
Yes.
So everything we do within that remit, everything we do on our operations side has to fit our mandate of price stability. But to see where we can take those kind of elements into account, and one example I can give what we already did So we hold corporate bonds because of the corporate sector purchase program. We hold them, we reinvested them for a long time, and there in 2022, October, part of this action plan that I explained earlier, while we were created, we decided to tilt our corporate bond holdings towards issuers with a better climate performance. So we did a backward-looking assessment. What did they perform in the past? How are their quality of their disclosures now? And also looking forward, how do they expect to transform? On the basis of that, we tilted portfolios towards issuers with a better climate performance. Why? Because we see it as to mitigate the risks of our portfolios, of our exposures. That was the main reason. And besides, we have a secondary mandate. So within price stability, if we have the opportunity to also contribute to the goals of the European Union, we have space for that. So there, it stands also on both feet there. We did see an impact. So of the purchases, most of it has been done by companies themselves, because you see that companies are reducing their carbon footprint already. But 1/5 could be contributed to the incentives that we have given with the tilting. So we saw that our purchases reduced the carbon footprint by 65%. 4/5 by the companies themselves, and 1/5
within the portfolio. Is that
of the reinvestments?
Of the reinvestment.
Yeah, what we did there. So now it reduces in the end what we hold. Mm-hmm. So there, the carbon footprint of the portfolio we hold is reducing, and at the moment that it's not longer on a Paris-aligned pathway, we have to reconsider because we're not doing active reinvestments now at the moment. What you said, it's not the timing at the moment. At the moment that it's not longer moving and moving down the carbon footprint, we will reconsider actions that need to be taken, but within the price stability mandate.
So, again, you mentioned there being an improvement I think you referred to an improved score. What goes into that score as you make those determinations, as you make that decision to tilt, right? Because that's very pivotal.
Yeah, so we acquired the relevant data, of course, for that, the Reuters sources. And on the basis of that, we looked back into what did the company disclose in the past, what is the quality of their disclosures now, and how are they planning to transition going forward, what is their ambition. And on the basis of that, we gave them a score, and we tilted our purchases towards issuers with a better climate performance.
Mm-hmm. Now, but back to part of my original question, is it a possibility that fossil fuel companies would be effectively barred from being part of the portfolio in the future?
I believe it's so important that we finance the transition.
Mm-hmm.
So how do we make sure that these, and we don't exclude, but how do we make sure that we finance the transition? And for the moment, we still need fossil fuels in our economy to run, because we haven't made this transition yet. So at the moment, this is certainly not the case.
Okay. And then on other aspects of monetary policy. So you don't have a direct role I mean, I guess you have a role in informing the models that policymakers are going to are going to review as they decide on interest rate decisions. But is there a specific model that you guys have developed that speaks more specifically to the inflation mandate on a regular basis?
So we did take into account more climate considerations in our forecasting already.
Okay.
Yeah. So how are we going to do that? So incorporated in our models elements that are relevant to climate change risk. So with the physical risk and the transition risk. So we are already incorporating that, but that needs to be improved as well. And this, of course, informs our decision making also on the interest rate side.
Interesting, just happenstance, the National Bureau of Economic Heemskerk Research, which is the outfit here that formally dates U.S. recessions and also has a substantial research arm. There was a paper out yesterday that was looking specifically at whether there's been substantial progress made over 50 major events over about a half a century and toward, that would indicate that we're making significant adaptation toward climate change. And this involves outcomes after disasters on everything from livelihood to immediate economic impact. And is the response, is the outcome better the next time? Their conclusion, to quote, is, "We find limited evidence of systemic adaptation to date." And it didn't just cover the U.S. This was a global look. That's a very sobering conclusion, isn't it?
Yeah, and I agree with it. And I believe that we have to approach climate change as a clear and present danger today, because we're just like putting out the fires or building dikes here and there after a disaster has happened. But we have seen an increase already in natural catastrophes. This will only increase going forward. So how are you going to shield yourself? So the UN requires countries to make a national adaptation plan. And that's, if you think about the transition plan, like how you want to be your economy to transition to a greener economy, you also have to make plans how you're going to make your economy more resilient of the physical impact we will face, and do a proactive approach there. And if you're talking about investment gap, well, for the transition, it might be still like beneficial. You invest in a new industry, you make money out of it. For adaptation, it's almost a bit like compliance, right? You're doing investment now to prevent something to happen. So how do you? And I think our work to show the losses that could be come from climate change, like the damage, that could build the business case from avoided losses to fund more adaptation measures here, and even and this is really a global issue. And one thing that really struck, if I look back at the past year, what really stayed with me, I met someone, a delegate from Samoa, a small island, West Pacific. Mm-hmm. And I asked him, do you worry about climate change? Well, basically, my family is thinking where they're going to be seeking asylum because we have to relocate. This is already happening today, right? In Panama, people are already being relocated from islands in front of the coast to the shore. So it's already happening now, but it's not happening enough. And thinking, okay, what is this climate change that we have to prepare for? So if you take into account all the policy commitments of governments around the world, in Paris we agreed to stay below 2 degrees and ideally 1.5. Mm-hmm. Currently we're on a trajectory of 2.7. So that means that we'll be facing much more severe impacts, and at the same time having the investment, unlocking the investment to make it less worse. So every 0. Degree Fahrenheit Celsius makes a difference. So keep it low. So to think of how will how will the planet look like? Where I'm going to invest in? Am I going to invest in a 2-degree world, or am I going to prepare for a 2.7 degree world and I'm not building houses in certain places anymore? This is the discussion that we need to think of now today. So experience climate change as a clear and present danger. Thank you very much, Irene, for joining us today. I'm Dan Burns, and thank you for watching this Reuters Next Newsmaker interview.